All right. Well, welcome everyone. As I said, please use the chat throughout. Let us know where you're from. Also, as we have this presentation going on, if you end up with a question, a point is made, and you want to ask a question, the chat is a great function to do that, and we'll have kind of a moderated Q&A at the end. Welcome to our 7th installment. Yes, the 7th installment of our Partner Summit series. I'm your host. I'm Steve Kampler, the president of Enactus United States. Today's discussion I'm really excited about, especially with everything that's in the news right now. Today's discussion obviously is, where's the economy taking us? We have housing prices, labor market shortages, workforce changes. You can't turn on the news without hearing about inflation, and we're going to learn a lot about all of this today. I'm very, very excited about the opportunity to sit back and learn. And we'll talk a little bit more about that. But first, I want to kick it over to our sponsors. We're very fortunate to have 2 sponsors for this. First is Rich Products, and I'd like to invite Jim Motos, the SVP of Consumer Brands for Rich Products, to say a few words. Jim.
Thank you, Steve. And we certainly enjoy being a partner of Enactus. What a meaningful organization this is, and the things that come out of so many students from this organization are so inspiring and mean so much to the future of this country and this world. I'm excited as well, just to echo on what you said, Steve. You can't turn on the news without hearing about the economy. And we certainly are feeling it from our business, along with what people are seeing for us on the grocery store shelves. So super excited to hear what we're going to learn about the economy, and just thankful that we have an opportunity to interact as partners and understand some of the things that we're all dealing with in this crazy environment right now. So thank you very much.
All right, thanks, Jim. And our second sponsor for this event is Regis. I'd like to thank them. They've been a sponsor or an Enactus partner for 22 years. They're committed to continuing that partnership well into the future, as they believe supporting next-gen leaders has never been more important, and the Enactus mission right now is critical. And so Regis shares and holds in the highest regard the Enactus values of integrity, passion, innovation, and collaboration. So we're so very happy to have them as not only a partner for a long time, but a sponsor of this event. Next up, I'd like to share a little bit about what we have coming up for our National Exposition. If you haven't been there, we encourage you to be involved. This year's a little bit different than what we've done in the past. We're actually going to have what we're calling a hybrid. The last 2 years have been done virtually, and this year we're going to have a little bit virtual and a little bit in person. So the opening rounds will be in March this year, which is a little bit earlier, March 14th to the 16th. It will be done online. I encourage you, and there's a link here, I strongly encourage you to sign up and judge. We'd love to have you a part of that. And then we will have an in-person event for our top 4 in our early stage and our top 12 in our World Cup qualifying. It'll be on Long Island University's post campus in Long Island. Very excited. This is the first time we've done it on a college campus, so I'm excited. I know our partners are excited about getting to a college campus. There's just something about the environment on a campus that is just excellent. So we're very excited that we have the opportunity to do that. For more information on that one, a lot more will come out after the opening rounds. There is information on our website that you see here. Just go check it out. You'll find out all that detail. That is April 21st and 22nd. That's a Thursday and a Friday. Okay, well, let's get started with today's event. As I mentioned, very excited about this one. We're very, very fortunate to have Tim with us. And as a senior economist for KPMG, Tim works in the office of the chief economist, leverages over a decade of experience in both public and private sectors to provide clients with a unique perspective on today's rapidly evolving economic landscape. Tim has worked with policymakers at the highest levels of the Fed as an economist and chief of staff to President Mary C. Daly of the Federal Reserve Bank of San Francisco, participated at high-level economic policy discussions, helped to drive executive engagement, spoke on behalf of the president and bank economic issues. So we're very, very fortunate with that background that comes in. Tim also has worked at Bloomberg, Citibank, and the International Monetary Fund. As a researcher, Tim enjoys creatively drilling down into data to illuminate sector and cross-country linkages. Now, as a self-proclaimed myself data junkie, that's the part that I looked at when I read his bio and said, this is what I really like about this session. So I'm very anxious to see what this means and what we have going. And finally, Tim has a BA in International Affairs and a BS in Economics from George Washington University and an MA in Economics from San Diego State University. He's also fluent in both Spanish and Portuguese. So with that, I am going to pass the floor over to our presenter, and Tim, I'll stop sharing and the floor will be yours.
Well, thank you so much, Steve. Can everyone hear me okay? Some head nodding, great. I'm gonna share my screen real quick. That's a very kind intro. I will say that I'm really excited to be speaking to everyone here today. I read some analysis the other day around how economists are always arguing over data and talking through numbers. And this economist will say, well, hey, look, that's great. What we really need is new technology. And where does that come from? It comes from places like Enactus that's helping people and training students to think through the real problems we have in the next 10, 20, 30 years. So I'm just happy to be a part of this discussion. I hope today you walk away with a little bit more understanding of how the economy works. The goal, I've been doing this for a while now, and this is the most uncertain and widest forecast bands I've ever seen. So my goal here is to, show you what our forecast is, talk you through it, but also then help you think about what's coming, right? So as you see the data come out in the next year, how do you interpret that? So those are the goals for today. And as you can see from the title, it's no surprise the training wheels are coming off. We've got policy rate liftoff happening in March, very likely, and we've got some unwinding of the asset tapering program that's going to end in March. So I'll talk through that, but essentially think of it this way: the monetary policy tailwinds that have been blowing us over the last 2 years are starting to dissipate a bit, and that's not necessarily a bad thing because the economy is ready for that. All right, so I'm gonna leave this here and go quickly through it, but essentially I think the deck will be distributed later. But there's a couple of big things we're going to talk about. One's inflation, and there are two drivers to inflation: that's supply chain and wages, and we'll talk about why we think both of those things are actually going to continue in 2022. Inflation is going to continue in 2022, but probably at a little bit slower rate than we saw in 2021. And then we're going to talk about what that means for the Fed, what the Fed's reaction means for the economy. And then there's some takeaways at the bottom for businesses if you're interested to know kind of how we at KPMG Economics would think through addressing these new dynamics. So I'm not going to bury the lead. There's a lot of discussion out there that supply chain issues are going to dissipate this year, and they will in our view, in some respect. But there's a lot of reasons to think that even if the pandemic ends today, that those supply chain issues will persist, or the imbalance between supply and demand will take some time to unwind. And one of those reasons is because inventories are very low and demand remains high. So just servicing current demand means you have to kind of try to keep up with your supply chain. You're not having time to rebuild what was drawn down during the crisis, during the pandemic. So here's a high-level slide that talks through why we think these supply chain issues will persist. The first is the pandemic. It's anyone's guess as to if the Omicron wave is the final wave. I've got my fingers crossed. But even if it is, which means the pandemic would essentially move to probably an endemic phase, there's a lot of things, there's pockets that could pop up of infections. There's returning to work that could, reignite little bubbles. So I wouldn't say that while the worst of the pandemic is behind us, there's still potentially some additional bubbles and surges we could see in certain places. That's going to impact how businesses and policymakers respond. The second is that, due to fiscal tailwinds that came from historic stimulus, a lot of people moved to work from home, which saved a lot of jobs. There's been high demand. There's been money. There's been high demand for goods, which means you have these tight labor. You have this tight supply chain with high demand. It just means inventories dropped, and there's no real resiliency in the supply chain. You can't just turn that back on. And we think demand is going to stay high. So as I just mentioned, that's a reason to think that we're going to continue to see some imbalances and some difficulty with servicing future demand, at least in 2022. And then the tight labor market, we're going to talk a lot about this, but if you just drill down for a second and talk about it in the distribution and warehousing sector, there were pre-existing issues with like shortages of truckers, shortages of dock workers that existed prior to the pandemic. That has only gotten worse for multiple reasons. You've got the short run issues of people calling out sick, other measures that people and businesses take to kind of space out people, and that reduces headcount in their workplace. But then there's also this issue of, just generally speaking, folks have moved from these types of jobs to other types of jobs. And that's a more permanent issue for some of these distribution networks. And then finally, this is more of a bullet or a piece that talks about where we are, but you can see that supply chain issues have boosted, or I should say, elongated supplier delivery times. And these things move around. That's a bottom chart on the bottom right. These things move around, but that's a very high level. And it's going to take a little bit of time to bring those supplier delivery times back down, which is, again, another bullet in why we think, even if you see alleviation over the course of the year, and especially in some products, the supply chain story is not going to go away in 2022, unfortunately. Another piece of that, I mentioned this, and I'll move quickly through this chart, but this is just a relationship that we're showing between, each additional rise in the case count, the infection rate, leads to 3 people calling out sick. So there's an outsized impact in the labor market. Now, these are temporary labor shortages, and you can see January 2022, just like one would predict, that there's a surge in January of folks that infection that led to a historic level of people calling out sick. That should unwind, and that's the temporary piece that should bring people back in and alleviate some pressures for distribution and things like that for business. But as we talked about, if this is not the end phase, or there's little pockets of infections in certain places, this story is going to continue with people calling out sick, which is going to cause little shocks to the supply distribution network. And as I mentioned, what this has really done, and what you're looking at here are two inventory to sales ratios. So it's the amount of inventory divided by total amount of sales, for the total businesses, and then for retailers. And you can just see that over the last, decade plus, the inventories have hit, very, very low levels. And so generally, when inventories fluctuate, you have a distribution network, you make phone calls, you buy more stuff, it shows up at the port, it goes to your business, your inventory level comes back up. But because of these distribution issues, you can't just do that today. And so these levels have continued to drop during the pandemic as demand for many goods has remained high, from people hoarding toilet paper to, for me, I have 2 young kids trying to find a crib. All of those things have been difficult, and they're going to stay that way because demand in this year, the economy is still going to be strong. And you have to, again, you have to service the current demand before you're going to go build up your inventory, which just means that resiliency piece is going to remain low until we get to a place where the distribution network is fully healed. So we've talked about supply chain. All of this points to inflationary pressures in goods, which we'll talk about later in the presentation. But that's one of the 2 big drivers of why we think inflation is going to stay elevated this year. The second is labor market issues. Now, if you think about supply chain and goods prices, that's kind of like I don't want to call it temporary. That word has been thrown around too much, but it's a shock that happens, and at some point, in the somewhat near future, year, 18 months, those kinds of pressures should roll out. The world's going to figure out some way to deal with this. These labor market pressures that I'm going to talk about, these are more persistent. And so what we need to be thinking about as businesses, and we need to be thinking about as policymakers, those kinds of things, are what do we do with these labor shortages that are, unless we see an economic contraction, are very unlikely to go away. And there's reasons to, recent history just makes, in my view, a really strong argument for that. So, I'm going to show you a bunch of charts here that have some historical data in them to just kind of level set for you why it is we think that there's some really strong underlying persistent dynamics in labor market. The first is, if we just look at total employment in the economy, you'll see that, so you're looking at this orange line, that's just the number of people in the private sector over the last 2 decades. And you can see that, generally speaking, as one would expect, it declines in a recession, and then over the course of the expansion moves up, usually to levels above the previous expansion, right? That's the hope, is that you're continuing to grow the economy because, you know, we have population growth and all of that. You want people to get jobs. And so the last expansion after the global financial crisis was a decade, one of the longest in American history. But it took 76 months, you know, that straight white line just past the just before 2010. It took 76 months to get back to the level of employment that we had before the global financial crisis. As you can see today, or recently, the steep drop in employment during the COVID crisis was historic, but then the bounce back looked kind of more like a K shape, at least initially. You know, a lot of people come back online. We're still roughly 1.82 million jobs below where we were prior to the pandemic. And so, but we still think it's going to take only 36 months, so like a little bit around half the time that it took in the previous expansion to get back to the pre-crisis level of employment. That's pretty fast. But what you can see from these dotted lines, the orange dotted line is our forecast of what employment was going to do over the next couple of years prior to the pandemic. And the white dotted line is what we think is going to happen now. And you can see, even though we get back to that level, we're off of where we would have been had there never been a pandemic. And so that's also kind of just a dynamic that occurs post-crisis in every expansion. Like if you were to take our forecast prior to the global financial crisis, it'd probably be an even wider gap. You never quite get back to trend. But it's just another statement to say, like, we're coming back quickly, but we need to remember that we still have economic scarring to overcome. All right, now this is my favorite chart in the presentation, but I'm gonna take a second to explain it because it's not intuitive, but I think it's incredible. Once you understand it, I think it really explains the situation. So in economics, we have this concept called the natural rate of unemployment, which just means it's the theoretical unemployment rate at a level of stable prices. So in this case, it's what unemployment would be if inflation was at the Fed's target of 2%. We can't measure it. It's one of these fancy things we put an asterisk after to just kind of say, yeah, this is just a magic number. But it's important because think of it as kind of the cruising speed of the economy. And so when we're thinking about inflation, we're thinking about growth. There's another thing called the potential GDP, which is the same thing but for growth. But when we're thinking about kind of where the economy is relative to its kind of cruising speed and what that means for inflation, we think about U star. And so if you take the actual rate of unemployment and you subtract U star from that, and estimate U star from that, you get a gap, right? You get a difference between those things. And so U star doesn't move a whole lot over time. It does shift. I mean, there's arguments around this, but generally speaking, it's very stable, and it's built on, or it's influenced by a bunch of underlying factors that are slow moving, more or less. Unemployment rate moves around a lot. So as you're thinking about this gap, a positive gap means that the unemployment rate is well above the cruising speed of the economy, which means you have a lot of people out of work relative to what you think should be, what's optimal from an economic standpoint. If that number is negative, it means the economy's hot. And so you have a lot of people you have fewer people out of work that want work than you would say, is optimal from a cruising speed in the economy. And so what this chart shows you is it's just each of those lines are the expansions going back to 1975 and how that gap evolved over that expansion. So what I really want to draw your eye to is how flat every line is except the red one, which is the one that related to COVID, right? So the way to think about this is you have all of these, in every other expansion, it's taken a long time for the labor market to kind of get back to that number, right? You're just adding jobs, the economy's moving along, but it takes to get to this straight line, which is zero when things are at cruising speed. It takes a while. What you see in this red line is that it dropped precipitously during COVID. And so when that gap closes so quickly, it has strong implications for, well, just when you hit zero, it has strong implications for inflation. This is more or less, we're kind of talking about one half of the Phillips curve, which you may have heard about a lot 3 years ago and how it was dead or not dead. But I'm not a dead Phillips curve person. I'm a flat Phillips curve person. And so if you just look at this relationship, it would tell you when you hit zero, you start to get more inflationary pressures. If it drops fast like this, you get even more inflationary pressures because there's this acceleration that goes on in the labor market. Now, this red line, it's very unlikely this thing is going to continue at the decline you've seen, right? The unemployment, the drops in the unemployment rate in some way, you have to have a couple things happen for that to continue. You either have to have a huge increase in labor force participation, which we're going to talk about why we don't think that's going to happen, and or you have a slowdown in the rate of job growth, which is going to flatten this line out a little bit. So, that's not to say we should expect, and you can see it started to flatten out, about 5 quarters ago or 4 quarters ago. But what you should expect is the speed at which this gap closes should slow, but that doesn't mean there isn't backed up inflationary pressure from the labor market. So, okay, like I said, one of the things we want to think about when we're thinking about just kind of overall labor supply and how fast that line's dropping is you've got, unemployed folks, which are people that have looked for a job in the last 4 weeks. And then you have folks who are, not in the labor force, as we call it. They're not looking for work. The labor force, the total pool of people to draw from that are active is the number of employed people plus the number of unemployed people. And so as the unemployment rate comes down, you need to bring people off of the sidelines to increase that labor force, bring them back in, have them look for jobs or get jobs that previously weren't looking in order to support that demand for labor. And this chart, it's a simple chart in the sense it's just one time series, and I'll walk you through it. But this chart really shows, in my view, why we should not expect that number, overall labor force, to pop. And so what you're looking at here, this orange line, is just labor force participation rate across the entire economy over the last 40 years, or 30 some plus years. And so what you can see is, this first part here from the late 80s recession until the early 2000s is that if you look at where labor force ended prior to that late 80s recession and where it ended up at the end of that expansion, it was up 0.7 of a percentage point. So it grew. The number of people coming into the economy, coming into labor force grew. Ever since then, it has declined from its previous pre-crisis peak in each of the last 2 and current 3 crises, right? So that early 2000s crisis is you dropped, where the economy ended up before the next crisis was 1.2 percentage points below, and in participation below where it had started. It was 2.6 percentage points below after the global financial crisis. Keep in mind, that's after 10 years of an expansion. It's currently 1.2% below where it was before the COVID crisis. And so there are counter arguments to this. Prime age workers between 25 and 54, their labor force, comes back up. And at the end of the last crisis, we saw, thankfully, in some marginalized communities, we saw those labor force participation rates tick back up. But if you're just thinking about total labor supply, this number continues to drop. And one of the big reasons is that our population is aging. And so you have increased participation for folks over 55, but they're becoming a larger and larger segment of the whole pie. And so their participation rate in general is just much lower. It's in the 40s. That just pulls down this overall average. And so it just means if you're someone that was going to do have a second career as a greeter at Walmart or work in a restaurant or do hourly accounting, those kinds of jobs, or you retire but come back, those are jobs where you're going to be looking for folks, right? Because those folks are not, they're not coming back like we've seen before. So this is a story about kind of the longer run dynamics in the labor market and why supply is not necessarily going to pop back. Another way to think about this, and this is another confusing slide, but I think it's strong in the sense once you understand it, is this shows you kind of like if you're so the last slide talks about this, what we call the stock, the number of people at any moment in the labor force or who are participating. It's a rate associated with that. This is monthly, how many people are re-entering, right? So this is a flow. So instead of, this is like a change, a number that's a change, like number of job gains. And so what this shows you is this is a number of people entering the labor force from not in, weren't employed, weren't looking for a job, to employed or looking for a job, monthly over the last couple decades. And what you can, that's the orange line. This dotted white line is that average over the last 5 years of the previous expansion. So why are we looking at that? Because that's when the labor market was its hottest, you know, in the last couple decades, because that's when we had 10 years of expansion. That's when we had folks coming back in. So just to level set, okay, where were we in the last expansion? What you can see recently, this big spike in the orange line, is that we're actually, if you just kind of in your head did an average, the current pace of people entering the labor force is actually higher than what we saw at the end of the last expansion. Now, that would seem to argue, well, Tim, you just said that that participation rate is going to be lower. So how does this make sense? My argument here is that this is because COVID's unwinding. And so we're seeing people come back in. So this narrative that you have this pop, the additional pops coming to these people re-entering from COVID, that's already happening. And you shouldn't expect this number to stay up at this level for years. This is a temporary re-entrant. And once you have that, there are not a lot of reasons to think that this number is going to be above that 2015 to 2019 average. So you're actually going to see we're getting that boost right now. And so as we're looking forward, you're going, okay, well, people are coming back in now. Maybe that keeps going for a while, but I should expect that rate to slow because it's above its recent historical average. And so that's why one of the reasons we're saying, hey, look, when you go to the previous chart and you see that decline, that's why we're saying that this rate of people entering is already kind of at a higher level than we would expect at KPMG Economics. And so those are two pieces of why, like, the underlying supply of labor is going to continue to be short of where we think demand's going to be. Now, if we just kind of break this down by sector, one of the narratives we've had in this expansion is that there's a lot of difficulty finding folks who are in person, maybe at the lower end of the wage scale, in these warehouse distribution, restaurants, retail, all of that. Some of that is definitely, a lot of that's because of COVID. So people want to go in, they readjusted what they thought was the amount of money they wanted to do that kind of work. But there's also an underlying trend here that we shouldn't forget about, and that's the education level in the economy continues to grow. And so what you're looking at here are two lines that show the number of people in the labor force by their education level. So as you can see, that white line are folks with bachelor's degrees or higher. That number continue, if you look from 2015 on, you can see the number of people, the rate at which that happens, so the line steepens, went up. And you can see that during the crisis, both of those numbers dropped as people chose not to look for work or become employed, but they haven't really moved back up. And if anything, you could expect this white line to continue given the trend that we saw prior to the pandemic. So why am I highlighting this? Because it's a sign that it's going to be, if you're someone looking for workers that don't require a college degree, that's additionally going, this additional education attainment in the economy is going to make that hard. You're going to have even further shortages of workers. And so, as you're looking at this and you're going, well, I'm going to have, if I was employing older workers, that's going to be an issue because they're not coming back in the same way. I'm going to have just generally less supply of labor. I'm getting the pop, the pop from people coming back in more or less now. So I'm looking a year, and then there's this educational piece. So I'm looking further out. There aren't a lot of reasons to think that labor supply is going to meaningfully increase, particularly for these in-person jobs. And that's an underlying couple years dynamic. I would say 2021, 2022, until there's like a movement. Unfortunately, if we have a contraction and all of a sudden the economy's, declining again, or there's some strange change in the labor market, then you could say, well, demand would precipitously drop. But at the moment, there aren't a lot of ways other than immigration potentially to see a big influx of workers, especially in those in-person, hourly jobs. So wage pressures are going to continue. this slide will go quickly. This just shows you what we all already kind of know, which is that leisure and hospitality, retail, trade, those sectors have been, this is the rate number of people reporting quitting. Each of these lines is like the BLS says, well, this is the number of people that we estimate quit their job. And it could be they quit because they wanted to get higher pay in a different job, but you just see that there's certain sectors have been hammered. It's the ones you'd expect. And then, so moving to what this means for wages. So what are you looking at here? This is the Atlanta Fed's wage tracker, and it breaks down wage growth in quartiles of the income distribution. So, and you have the kind of median hourly earning estimate next to each, on the legend next to each one, but more or less it shows you kind of how each quartile of the income distribution has experienced wage growth or declines. And what you'll notice is, so first thing to notice, and I think this is not always intuitive, these are growth rates on the y-axis, not levels. So even though you see some lines declining, that doesn't mean wages declined. It means the rate in which wages grew was declining. There's still wage growth. But what I want to point your eyes to is this green line. This folks at the lowest end of the income distribution have seen, just as we all know, incredible wage growth over the last year. Now that, even with everything I just said, with labor shortages, particularly in that area, it's hard to come up with a scenario where this continues at 6, 7, 8% for 3 or 4 years. It may continue for the first half or even into early next year, but this cannot continue before businesses start to say, this just doesn't make sense anymore to even go to the labor market. I'm going to really implement some of these capital intensive labor saving measures. And you already see, businesses have been doing more with less, right? You show up at a restaurant, you're on an app, ordering your food, someone just drops it off. Grocery stores, fewer people as well. And so that trend's likely to continue. Part of the reason this green line has popped is this thing in economics we call the reservation wage, where folks have a minimum amount in their head of what they need to do a particular job. And in COVID, if you wanted someone to go in and potentially contract the virus, you had to raise wages rather quickly. So some of that increase in green is that one-time shift up in people's expectation of what they need to do a certain job. So that, again, another reason to think this isn't going to continue at that level. But the other thing I want to point your eyes to, though, is if you look at this orange and brown line, you actually see over the course of the later part of the pandemic that the growth for folks in the top half of the income distribution was slowing. Wage growth was slowing. And so you would say, okay, well, I hear labor shortages, but then I'm seeing the growth, the growth in wages is slowing for these types of generally professional services workers. So maybe inflationary pressures are overall are not going to be as bad. Well, but look at the last couple months. All of those lines have turned up. And so even if you have some decline in this green line over the next year or two, you're seeing pressures now broadly across the entire income distribution. How high these go is anyone's guess, but I would say it would be surprising to me, given what we expect the economy to do this year, which is to continue to have solid growth, particularly in consumption, that you wouldn't see, and you have inflation continuing to remain elevated and inflation expectations moving up, which means people are going to ask for more money when it's time to renegotiate. It would be surprising not to see these numbers continue broadly across income distribution. So when we're thinking about inflation again, it's really these two pieces. It's the supply of it's the goods, and that spike from goods, and then it's kind of this wage tsunami, which is slower and harder to turn around, which is why the Fed is starting to move. So again, we think inflation is going to be high this year. And I'm just going to quickly talk through this, but I wanted to level set and go back to the 60s and 70s, the last time we had high inflation, and say that even though inflation's high, it doesn't look like the 60s and 70s. We still had crazy double-digit inflation there. That said, we estimate that 75% of today's labor force has never worked in an environment with inflation above 7%. So what does that mean for your business? Including myself, there are a lot of people that have never had to make pricing decisions, wage decisions, labor market decisions in this high inflationary environment. So there's just a lot of knowledge that maybe was here 2 decades ago that doesn't exist anymore. So we're all going to have to adjust and think through how do we approach this high inflation wage pressure environment? But you can see from the dotted lines, which is, orange is headline CPI, white is core. Core means you strip out energy and food, which not going to say they don't matter, but that's just kind of, they're volatile. So it doesn't necessarily give you a good underlying measure of inflation. But we expect both of those to come down. This slide, if we're looking at inflation and say, okay, well, why has this been going on? Shocks no one on this call to say that it's a lot of it's been in core goods, right? Look at that white line just spiking. Again, if you think supply chain pressures are going to persist, it's hard to see this line come back down to hover around 0, which is what we saw in the last expansion. I mean, look at how long it's basically around 0. But you could see a situation where certain things start to alleviate, certain supply chains, start to right themselves. Maybe demand for goods is a little bit slower as the Fed moves. So this white line should come down a little bit. But this orange line, services, which comprises 60% of this inflationary basket, is going up. And we expect that to continue as people, as we hit summer and folks are like, I want to take another vacation. I want to jump on an airplane. There's still a shortage of used cars. I mean, these services, this service price inflation should continue at least at the level it's at now. And so even if you have some moderation in goods inflation, there's going to be a larger segment of services inflation, with still elevated consumption that you have to think about. So, this reallocation is important, but it doesn't necessarily mean there's less inflationary pressure. Now, this slide is kind of the key to the whole discussion here around policy. So when we're talking, when the Fed's sitting there and they're going, okay, how do I approach this environment? They're not going to react to the moment, because there's research on this, but monetary policy, as John Williams, my former boss, who's now the president of the New York Fed, used to say, it acts with long and variable lags. You raise rates today, those impacts are not going to come for a year to, year and a half. And so they're having to look further out to say, okay, what do we think these dynamics are going to be in the economy, so that we don't overdo it now, right? Because if you're looking at it, you're like, I'm going to raise rates to a full percentage point, I got to cut this thing off. One of the key metrics by which policymakers and economists look at the underlying pressure in wages or in inflation is inflation expectations, consumer and financial inflation market expectations. This chart shows you there's a survey by the University of Michigan that goes back decades that asks a whole suite of questions every month to consumers around what they think inflation is going to be. They ask at the 1-year interval, so what do you think inflation will be over the next year? They ask at the 5-year interval. The reason you look at the 5-year, which is what this orange line is because 1-year expectations of inflation very much track commodity price movements and don't necessarily give you a signal of underlying kind of the momentum of inflation. The 5-year expectations, if you ask someone, hey, where do you think inflation is going to be 5 years from now? That's a better barometer of what they think pressures are going to be. And if someone said, hey, Tim, where do you think inflation is going to be, 5 years from now? And I said 3.5%. I'm going to go to my employer and go, I want at least 3.5%, right? So that's why this orange line and this longer expectations are really an important measure of kind of underlying pressure. And what you can see from this chart, there's 2 lines. This thick white line is the average over the last 2 decades of where people thought inflation was going to be 5 years from whenever they asked it. And so that's 2.8%. You can see the current orange line is at 3. That was the latest reading. So you're like, whoa, I'm 0.2 of a percentage point above the long run average. And I would say, yes, you are. And you can see the orange line has been going up. However, if you're talking about absolute value for all of you math geeks out there, there's still more space between, I'll do my cursor over here, between this white line and how low inflation expectations were at the end of the last cycle, than there is between this orange line now and this white line, meaning we're not as far from the average of the last couple of decades as we were on the downside at the end of the last crisis. The next thing I'll point you to kind of argue that inflation expectations are not yet super alarming, we're getting to alarming, but not super alarming, is that this white line, the smaller white line, shows you that in the last expansion early on, they actually hit 3% for a little while. So we're not out of line. I'm not saying this is not something to worry about. You should look at the steady pace of this orange line and go, something's going on. But we're not at a point yet where I would say, the economy can't can't slow inflation, that we can't get to a place where this thing slows down and people's expectations of inflation don't ease. If this orange line were to continue to march up steadily for the next 6 months, that's a very concerning sign, especially as policymakers are removing accommodation. Probably, you see forecasts for, two full percentage points this year. It's not our forecast, but you see that, right? And so if that's happening and expectations are still going up 6 months from now, I would be concerned. At the moment, it's just more of like hey, we need to pay attention to this and we need to get ahead of it. And again, if these expectations don't continue to climb, then you're really going to have some easing of wage pressures, because people are not going to require that kind of income increase to offset higher prices. I'm going to go quickly through these because this is just more of a thought experiment, but it's an interesting one. We ran 2 scenarios and we just said, okay, well, here's our expectation of 4 rate increases this year by the Fed. What does that do to the economy? And then we said, okay, let's come with a worst scenario where we think inflation is going to be higher than we expect. And then that means more Fed increases. What happens to the economy? What I'll run through them, but what you can see is that even with this kind of worse, more difficult scenario, I won't call it worst case because that's when you get yourself in trouble. There's always something worse. But when you look at these 2 kind of hot baseline and higher inflation scenarios, and then the Fed response, you still get to a place where the economy is fairly strong. And so, as you go through this, you'll just see the dotted lines are the alternative high inflation scenario. The solid lines are our baseline scenario. So you see, we expect in the solid white line 4 Fed hikes this year in the base, and which corresponds to the solid orange line in inflation, which is high, and then, over time coming down. And then you see higher inflation, the dotted line means more rate increases. As we go through this, I want you to keep one thing in your head. That's the yield curve. What is this? It is the market's, more or less, the market's view on the ability of the economy to absorb the appropriateness of rate policies, I'll put it. So this orange thing, this space, is the 10-year Treasury yield, or I think this is the 5-year. This is there's different yield curves. It's the 5-year Treasury note minus the yield on the 3-month. So when this is positive, like it is now, it tells you the markets expect higher yields 5 years from now than they're currently trading at for the 3-month. So it tells you that markets think that the economy can absorb additional rate increases over the next 5 years. Because if you didn't think that, 5-year yields would be much lower, and you'd get what you see in the crisis, which is a yield curve inversion, when the current rate of interest is higher than what people think it should be 5 years from now to offset, inflation and risk and all of that. And the yield curve, well, I would say the causal relationship between this and the economy is difficult. It does do a good job of predicting when we're about to enter a crisis, because you can see, it's done this the last 4 times, but you can see there's an inversion over here right before the crisis. The markets went, wait a minute, something's not right. I don't think the economy, I'm not going to trade a yield that's 3% 5 years from now when it's at, or I'm not going to trade at 1, at 3 when I think it should be 1, that policymakers need to drop their current rate. And so that just shows you that when this thing starts to turn south, that's when markets are saying something's going on in the economy. We think the rates may be too high for the current environment. But as you can see, even with the Fed coming out in their economic projections and saying we expect 3 rate increases in December, which is half of the rate increases the market currently predicts. They think it's going to be 6. There's only 7 more meetings, by the way. Though this yield curve has continued to widen, which just means that even with the expectation of further increases, that the markets think the economy can handle that. And so I'm going to stop. There's just some scenarios in here for people to look at. You can see, our inflation scenario. You can see what this does to growth, which means more rate increases, higher inflation means slightly lower growth, but still continued solid growth above kind of where we saw things at the end of the last expansion, even with 7 rate increases. But these are just an argument, and that's our forecast to say, look, we thought about the economy. We thought about an alternative scenario that was plausible with higher inflation and more rate increases, and we still got to a place where the economy was looking strong. So demand is going to continue to be strong. Markets think the economy can absorb these kinds of rate increases. We think supply chains are going to continue to be disrupted this year, and the wage pressures will continue. And so you've got this kind of this place where you've got two drivers of inflation keeping price growth high, tightness in labor market being one of them. We don't see that alleviating. But then the Fed's response is to then raise rates, which hopefully cools things a little bit as we go into 2023, which we will still, could see inflation above 2%, but not necessarily at, the average we saw last time, which was, 4.75% at CPI and almost 5%, the average, not the end of year. So that's just to say, we think things are cooling. We see the Fed being more, having more increases than we saw early in the middle of the last cycle, but the economy can handle it. And with that, I'll say, Steve, do we have any questions?
Actually, we do have a few that have popped up. But before we get into that, I have one quick question that I'd like to pose. And since I'm the moderator, I get the luxury of being able to do that. So you read a lot about, past inflationary times, and it tended to be more among, the rise in services to deliver, whether, the supply chain caused some of those issues, and less about the labor market. This one has more of a labor market twinge to it. So I'm curious what that means longer term. But then I also want to have you answer part two of that, which is, I read a lot of business journals, and in past inflationary times, corporate profits were down. In this one, corporate profits are up. And I'm wondering what the difference is in that.
No, those are two great questions. So, and I think they're actually kind of linked together through the investment channel. So, if our forecast is right and you have persistent shortages of workers and continued strong wage growth, businesses are going to start thinking about labor saving technology where they can, right? Because over the long term, you make that investment now, it reduces your costs, right? And so that's the first piece, is if this world continues, there's going to be, the cost of capital is going up with the Fed raising rates. So now, maybe a good time to start thinking about those capital plans if you have them on the shelf. But that movement towards labor saving technology is likely to be showing up in certain places, many places, and in certain places, maybe the service sector, which has kind of lagged in that relative to like manufacturing, that may become even more, or there will be a faster rate of investment or increase. That's the first thing. The second is, corporate profits are interesting because, there was this weird segmentation in the economy where if you could shift to work from home, people did that quickly. Businesses did that. Revenues were up, costs in some ways came down, and equity markets popped, right? And so that leads, to having more of these liquid assets that you could then use to invest without having to go out and borrow. And so that's a function, I think I'm not an expert in this, but at who made how much money and when. But if you're just looking at the aggregate level of the economy, cash is on hand is up for many corporates. Interest rates are going up. The cost of holding that cash is going up. And so, if we're thinking about tight labor markets, perhaps deploying some of that cash is the way you'd want to go when thinking about how the labor market's going to look in the next couple of years.
Great, thanks. So let's go to one of our questions that we had. It actually is around the supply chain, and between trucking shortages and shipyard delays. It's a two-part question. First question is this just a matter of the market misfunctioning here? Would it take like a reset in the market as far as trucker pay to solve that issue? So did this just bring up a systemic issue, or is there something else there?
That's a great question. I'm going to take a stab at it. I am by no means an expert in the labor market for the transportation sector, but I do know when we were at the Fed, we would hear from our business contacts. People don't know this. I'm going to do a quick plug. All of these policy institutions do listen to businesses quite regularly. It's not just a bunch of wonks sitting around with waving their hands at numbers. And so when I was at the Fed, we would go out and we would say, hey, what are you seeing? And we talked to these truckers out west. And they were saying, we can't find people, right? We got these trucking schools that are sitting with like half capacity. This is in 2016, 17. And so part of it, I think, was wages. I mean, wage growth, as you saw in that slide, was fairly modest over the last expansion. And so, yeah, it's tough work. You're sitting around for 12 to 18 hours focused on the road. I can't drive 4 hours at a time, right? Forget the kids. I can't drive 4 hours by myself at a time. So that's long, hard work. And it's under extreme conditions getting things to market. So that, you could argue maybe wages were too low in that case. It could just be folks wanted to do something else. I mean, this is the other part of the labor market that we can't measure at the moment really well, but we're kind of seeing in certain places is people are reevaluating how they want to spend their time, and I think if you can I think that is changing what people view as work they want to do. And so potentially some of that was going on prior to the crisis. I have no data to support that, but it's kind of shown up in spots in the pandemic. And I can't imagine that was all just because of COVID, maybe a lot of it, but not all of it. So maybe some of that was going on too. What I do know is that those trucking schools were shuttered during much of the early days of the pandemic, like many things were, which only creates a worse backlog. So not only did you have a shortage of people wanting to do it, the few that did want to do it couldn't be trained. And there's a long, trucking is a skill. There's a long lead time into that. And we're now backed up with that as well. So it's just to say, like, these shortages in these transportation, and then of course you have folks in the warehouse industry, those are, that may be like, oh, I want to be a trucker. Well, their wages are going up. So like, well, why would I, so you've got these competitive spots in distribution chain that are causing these shortages. I'm not an expert, but I can make an argument as to why those are probably going to continue.
All right, we got time for one more that came through, and then we'll move on. So given future projections, looking heavily towards prior trend activity, what factors were not fully anticipated, which drove the initial guidance that we were in a transitionary inflationary environment?
Oh man, I feel like I'm back at the Fed or someone's like taking your research paper and going, hey, what are you saying? No, it's a great question. It's hard. So one of the things economics does really poorly, and this isn't necessarily anyone's fault, where there's a lot of thought that goes into it, is measuring inflection points. So if underlying dynamics are stable, we can kind of forecast forward and go, well, with some accuracy, inflation next year is going to be roughly this. The underlying dynamics of the economy are the same. Where we struggle are these moments where there's these huge forces that change the way in which we work, that change the way in which we buy, that change the way in which the relationship between those things and prices happen. You can't necessarily, you have some folks out there that are looking at them and they have data points, but if I was going to be fair, you'd have just as many people calling for these inflection points all the time that aren't. So a broken watch is right twice a day. And generally speaking, we don't see these things well. And so what happens is when you ask these questions about underlying dynamics, is we're looking around the data and going, well, what narratives do we see, right? And if you're thinking about the accuracy before the crisis, I'm not sure that, I remember sitting there, and going, my son was born, my first child was born a couple of days before lockdown in San Francisco, which is where I live. I was at the Fed. And I remember getting the text message on the weekend and going, oh man, I just put my paternity leave in and now some stuff is going on. And so I remember at the time thinking like everyone else, just me personally, this is going to be a temporary thing, work from home, temporary thing. And so I'm not sure, and the housing market, I told a friend, he didn't listen to me. I was like, don't buy a house. The market's about to dip. And he was like, no, you listen to you, buy a house in San Diego. And he did, and house prices went up, right? Because again, who would have thought that in a crisis that we've seen house prices surge like this? And so these weird dynamics, some of them are temporary factors that will go away with the pandemic. Some of them may be things that are now like somewhat permanent. Work from home may continue to elevate house prices outside of certain areas. Working from home may change the way we negotiate for wages, right? Which has inflationary implications. I'm not sure anyone could have seen that realistically prior to the pandemic. Now, but if we're thinking about today, and I want to end on this, I want to think about what's going forward. That doesn't mean that we can't learn our lesson a little bit, right? And I think the thing that we want to think about as economists, and this is where I started off by saying technology is something to talk about more. The future, what work you're doing at Enactus, climate change, all that stuff it's coming. It's here and it's going to continue to come. Changes how we do work. Let's be bold in how we think about we're going to address these economic issues. Let's not sit there and say, well, I think that we're going to go back to the old world. The old world has passed us by. And so now is the time to think outside the box in your business, in your education with technology. I'm going to beg all of you students on the call, pull us out of some of these long run issues that are coming down the pipe. And let's start thinking about things differently, because the economy has changed and we need to meet that change with new ideas.
Couldn't agree more, Tim. And first off, thank you. Thank you so much. This was absolutely enlightening, and certainly gives us some insight in the types of things that we want to do moving forward. So thank you so much for being with us. And we truly appreciate that. As far as next steps for everyone, and this is a part that Tim actually hit pretty hard. Our next event is going to be March 16th, and it's going to be about around the Great Resignation. We had a record number of people leave their jobs. How did this change the workforce? All of those things are coming into play. To be featuring, as of now, featuring Tim Hurd, Executive Vice President of Enterprise Optimization for Robert Half. So we hope that you'll join us and continue these sorts of discussions as we go. And with that, I'd like to say, on behalf of everyone here at Enactus, thank you for attending today. Tim, again, thank you so much for your insight. I know I've got a lot more reading to do than I currently do to make sense of all of this. So I appreciate you making a little bit easier. But on behalf of Enactus, we'd like to say thank you so much for not only being here, but your continued support of our mission and our vision to make a better, more sustainable world. So thank you, everyone, and have a wonderful day.